Hello, fellow traders. 'Tis I, the Rumpled One. Let's talk trading. It is Tuesday, November 14th, the year 2017. Buy zone, rat zone, wick zone. Some of my favorite trades. So let's get right to it. We'll take a quick look at what's going on the weekly chart. You can see here most of the gaps have filled, but there's still a few on the pound, and we've got one on the Euro GBP that haven't filled. So once again, that simple horizontal line trade, the gap and the weekly open would have paid off. Okay, let's take a look here at the buy zone. Simply, we take the daily open. And if it gets to a certain threshold, and here we have the open plus 8, open plus 10. Right in here's the buy zone. So if you took this trade here, you took a little heat for a while, but then finally it popped through and there was a winner. And it came back down, it hit the short zone right here, and there was a winner. Then it actually opened above and there was another winner, and you might still be in it. And as you can also see here, the weekly open, if you were trading a weekly open buy zone, you would have made some pips right here. So once again, it's simple. And if you look back here, there was another weekly, couple more weekly open trades from yesterday. I think we discussed those. So you can see here, buy zone, a simple horizontal line trade. And you can change these parameters. You might want to use +4, +5. You might want to use even something higher. But basically, the buy zone says, you know, the high is probably going to be higher than the open, and the low is probably going to be lower than the open. And when you look at those statistics and you see that distance, the high minus the open and the open minus the low, and I believe I have that right here, and this is on the daily. You can see here we had 29 and 31 for the yen, and on the Euro New Zealand we had some big numbers here, anything over 100 highlights. And you can see most of these numbers are over 10. In fact, I could even go in and change the threshold so you can see, or I could say over 8 because we have the trigger. So right here you would have had a trigger, and here you would have had a trigger, but it reversed on you, and you would have taken the stop loss. But that's trading. You're not going to win every trade. So that's the buy zone in a nutshell. Feel free to ask more questions, or you should know where to look for the forum where I post this stuff. So that's a real simple indicator. In fact, you don't even need an indicator. You can draw a horizontal line at the daily open. Just use the, switch over to D1. Here's the open, plot a line. Switch back over to H1 or whatever time frame chart period you like to look at when you trade, and just trade the cross. Let's move on. The rat zone. Okay, for those who aren't familiar with the rat zone, real quick, once again, price is going to make a high for the day, price is going to make a low for the day, and price is going to reverse off the high and reverse off the low. At the end of a day, usually the distance between the low and the close is greater than 20, and the distance between the high and the close is greater than 20. And that's where the rat zone was born. Just playing the price action, that movement, that price travel off of the extremes. So you see, price has to range away from the open, and price usually ranges back from the extreme. So in the one case, we're going away from the open. In the other case, we're trading towards the open. That's the difference. One trades away from, the other trades towards. Now, there'll be a quiz on this later. So you can see here, we got the red rat zone, we got the green rat zone, which is actually highlighted blue. Now, the one thing about the rat, you have to be either a red rat or a green rat. Otherwise, you're a Yale student. Because the beauty of this method is, if you pick one, you know, sooner or later you're going to be right. But if you keep trying to flip-flop between the two, you can get cut up and always be on the wrong side of the trade. Now, what's the trigger? Well, right here, this is the final entry point. In other words, if you get in here, you missed the boat. The ship sailed, okay? So one of the methods is what we call the rat reversal. Red candle closes, green candle closes. You take the break of that green candle. So right there, that's where that would have been the optimum time to go long. Now, red rat, it's just the opposite. Green candle closes, red candle closes. You take the break of that red candle, and you can see there would have been some pips in your pocket. So that's the rat zone in a nutshell. And yeah, you can get the rat zone indicator with all these, with the gauge and with the triggers over here. Yeah, you can download that one for free. No donation required. And see, the buy zone and the buy zone's been around for over a decade. In fact, I used that back when I was trading the stock market very successfully. A very, very successful method. And I just adapted it to foreign exchange. And the rat zone, he never really tried that with stocks because I invented that when I moved over to the foreign exchange. So there you have it, and you can see here it'll even tell you if it's okay to buy or not. And that's based on the H1 bias. See, we got the training wheels on. So it's only going to tell you to go long at the opportune time, because you don't want to trade against the H1 candle color. We can see we've got it red right here. And if we switch over to H1, you can see it. There it is. It's red. So we're almost at the top of the hour here. You could see server time, local time. So about 2 minutes. So the prudent thing to do would be to wait, let this candle close, see if the next candle might test the bottom, it might not, and then go ahead and take your green rat trade. But let's move on to the next one. The WICK zone. We've got the WICK zone, which you can see here. It's not labeled, but we've got the, and we can, let's just take a quick look here and see what we got. Okay. Previous day's high, previous day's close, previous day's open, and previous day's low. Now, I like to use this on either the H1 or the M15 chart period. Now, what is it about the WICK zone? The thing about the WICK zone is price, once it gets in the zone, it likes to leave the zone. It's just that simple. It usually happens 70% of the time or better for the daily wicks. You can do it also on the weekly or the 4-hour or the hourly. You can see that price does not like to stay in the wicks. It's just that's just the way it is. Very rarely will price stay in the wicks. Sometimes it will, but not usually, and not for a very long time. Price ranges. It's just that simple. So you can see here there was a lot of action into that zone. It always opens in the zone. It moved up, came down. Okay, here it moved up into the zone, barely poked its nose out, and then here we had a nice break, and then here we had a nice break, and then we got back in and we left it and came back in and left it. Now we're diving back into the zone. So the thing is, you don't want to overtrade. you might want to use a little discretion. You might want to say, well, I want to see it test the zone a couple of times before I take the trade. Or you might just say, well, you know what? It already ran its course here. What's this? High, high, lower, high. This is, building on what we talked about yesterday. It's coming back. It comes into the zone. Now it's getting back in the candle body from yesterday's candle, and here we're right back into the zone. So some people like to trade diving back into the body. Some people like trading the breakout to make a higher high than yesterday or a lower low than yesterday. Okay, and this indicator, that's the old 2014 donational. But you don't really need to have that. You can use the free to download TRO HL5. And once again, you can see here the wicks, and we can switch this over to the hour. And so you see here, there's yesterday's high, and there was that breakout. Okay, you can see here, and then it put in the high for the day, came back down. Here it crossed the open, so there's your buy zone trigger. This would be your wick zone trigger here. And yesterday's open, you're diving back in the zone. Here's yesterday's low, and so far here's the low today. So that shows the wick zone. Once again, simple horizontal trade. Now let's see, we go back to the hour. Okay, and as I thought, it's going to probably test here. So what you do is you'll wait for a wrap reversal. Remember, red candle closes, green candle closes, take the break right here. Take that breakout or crossover. When it crosses that line, that's when you go long. So here we need this to close. We should see a green candle open, and then now if the green candle breaks this one, you could probably go ahead and jump in. But a true wrap reversal, you need to have a red green, and that because that's also a price turn. If you go back and look at my price turn video, so those are the three zones. And once again, we looked at this yesterday. You see here the 3 ball came in, made a lower high, and so then right here on a wrap reversal or just plain price action, you see there's the break, and there were pips to be had. It's not hard. And as always, no squiggly line indicators were harmed in the making of this video. So fellow traders, that pretty much wraps things up here. So I hope you have a profitable day. And as always, fellow traders, it's not what you trade, it's how you trade it. TheRumpledOne signing off to drain the banks.